this in the end about yields when it comes to markets, and also the divergence in terms of policies between the US as well as China?
Yes, that's right. And when you mentioned yields, I think it's real yields that we need to be focused on for like the really big trade of the year, which is out of long duration growth stocks and into shorter duration value stocks. So one of our highest conviction trades for the year, the overweight financials and energy, that is playing out. And we think it's got a lot further to run because we think real yields, which at the 10-year maturity are about minus 60 basis points now, are headed to minus 30 basis points. That's obviously coming out of the US. And again, we can talk about China in more detail, where the policy is clearly going the other way, at least on the nominal rate side.
We talk about the surge in yields. You take a look at 10-year yields at 1.87 right now. I mean, put it in perspective, it is not that high still.
Yeah, again, obviously that's way below trailing inflation. So when I've referred to real yields, I was referring to how you can back that out of the TIPS market. In a like sort of textbook normal macro environment, you should expect positive real yields, but we haven't had them really since COVID hit, which is, I guess, sort of 2 years of negative real yields. And the point that we make about the US market in particular is that this phenomenon blew up an extraordinary overvaluation, in particular in NASDAQ and parts of growth stocks. It's fascinating, actually, because the start of this year is playing out in the US very similarly to what happened when credit conditions tightened in our markets here in Asia, in China, a year ago. And we saw what that did to long duration growth stocks in China starting last year.
Jonathan, Rishaad, just, I think Haslinda was alluding to this. The two directions of monetary policy in China and the US, in fact, globally, we can talk about tightening monetary policy. How does that affect the way that you look at your portfolios?
Well, I think one thing to watch very carefully is the currency, is the renminbi. We do expect the US dollar to be broadly strong because of the tightening of real yields. And in China's case, they have this enormous trade surplus, which is a cushion for the currency. But generally in Asia and EM, when you get that nominal rate kind of like gap narrowing as US rates go up, that does tend to put downward pressure on the currency. And it's one reason why we're not as bullish as some of our competitors on the outlook for the headline indices here. So Hang Seng, our base case target is 25,000. It's had a reasonable start to the year with the financial stocks doing a lot of the heavy lifting. But one doesn't want to get carried away, given the fact that the currency could come into play here a bit.
Yeah, absolutely, Jonathan, and that's it. It is, isn't it? I mean, everybody seems to kind of be bullish in the medium term on the dollar. It's often the case in FX markets that everybody is part of the herd, they get it wrong. What's your take on all this?
Yeah, so a year ago, our FX team made a great call to be neutral to bullish the dollar at a time when everybody expected the dollar to fall heavily last year. This year, they're actually much more nuanced in what they're saying. We're not anticipating an extreme dollar strength or anything like that. In parts of my coverage in EM, where you don't have such strong external trade positions as, for example, we have in North Asia, you're already seeing currencies that have made some pretty significant declines. And that poses, policy dilemmas for policymakers in places like Brazil, for example, or South Africa. I think here in Asia, we are more constructive than we were in previous cycles about India and Indonesia. We do think that their currencies are going to be broadly stable against the US dollar. And that does unlock a potential for those markets to enjoy a fairly normal cyclical upswing. In China's case, though, this is not a normal cycle.
You say Singapore is a defensive play, and we don't talk very much about it, and it's time to look at Singapore stocks.
Yes, we were bullish on it for last year, and we carried that over into a strong overweight for this year. So yes, it has low beta. And bear in mind, the Morgan Stanley house view is the S&P 500 goes to 4,400. So we definitely want low beta, but it also has a lot more than that. It's got a very strong value component at the sector side of things, in particular, some very strong banks in the index. It's got a rock solid external position running very substantial current account surpluses. And it's got this, I would characterize, sort of creative approach to managing COVID, which is going to see it well over the medium to long term. So it's nice to see that Singapore is one of the markets that is up year to date.
Jonathan, also, I want to quickly get to this, going on much time. And looking at Japan, you're pretty bullish on Japan. You know, people seem to think it's going to come back. It's always jammed tomorrow to some extent. But what do you look for in Japan? I mean, stocks there can be really, you can see companies with a lot of cash on their balance sheets. Are the real drivers essentially going to be perhaps share buybacks rather than share appreciation of the top line?
Yes, there is a buyback theme and a dividend payout theme that has worked quite well for investors in recent years. Again, it's a market that has value characteristics, and the Japanese banks, for example, offer very secure dividend yields and extremely low forward PEs. But I think, you know, for Japan, it is going to be challenged, at least the growth parts of Japan, by the sell-off in NASDAQ that is underway. So one does have to be careful because there's obviously some parts of the market that will not do so well.
Jonathan, before we let you go, just the risk factors out there, the risk to your baseline and your targets.
Well, I think it is skewed to the downside. I do think that we are exhibiting still downward momentum in the Chinese economy. And in fact, the global economy, at least near term, has been weakened by Omicron. So we have to watch that because the combination of slowing growth and yet firming rate expectations is clearly starting to dislocate markets. So I think the overarching environment for the first quarter is to be quite cautious, and that's what we're trying to recommend.